evening. I'm Peter Resnicek from ShadowTrader.net, and this is the Weekend Edition. This is a special show because we are going to talk about a lot of different things, especially about weekly options, and you're going to have to read between the lines a little bit because it's not going to be like a specific course or anything like that or any specific teachings, but I'm going to show you some recent trades. We're going to do a should I do this trade, and through it all, I think you're going to learn a lot about weekly options and be able to take your game up to the next level, starting as early as next week. All right, without further ado, let's get into it. New highs again this week, but with a lot of sector rotation, and this is really important because this is what we discussed in last week's video, talking about how the market refuses to come down, and the reason for that I was giving was that a lot of those sectors outside of technology simply aren't bearish. And when I go through the next couple of graphics, I'm going to show you how those sectors fared this week. Let's take a quick look right here at just Thursday and Friday. Now these boxes here represent percentage change from the open of the 11 sectors that make up the S&P, starting with technology, going all the way to real estate. And remember, they're all weighted. So technology and healthcare and financials have the greatest impact on the S&P, and these sectors towards the end, such as materials, utilities, etc., they have the lowest impact, right? And I wanted to start with this graphic specifically this week because Thursday and Friday were down days in the market, if you recall, right? Monday and Tuesday were positive. Wednesday was a day off. It was a holiday. And Thursday and Friday were down. Thursday, we had a good amount of selling, and Friday, we closed relatively strong, kind of in the middle of range, but we made a new two-day low. But look what the sectors were doing, especially here on Thursday, right? I was talking last week saying that we could easily have a situation where money starts rotating outside of technology and going into the other sectors rather than an all-out sell-off, which would keep the S&P elevated for some time longer, right? We would not see that big sell-off because we know that we need all sectors participating in order to have a broad market sell-off, so to speak. So look what happened just on Thursday. Look at the dark red there, technology down quite a bit, and look at the sectors here that are dark green. Dark red means down more than 0.5% from the open, and dark green means up more than 0.5% from the open. And notice what happened on Thursday. Again, technology down, but where did the money go? Not out of the market as a whole, but into healthcare, into financials, into utilities, into energy, and to a smaller degree here as well, into consumer discretionary industrials, communications, etc., right? Friday, as I was saying, lower low in the markets. Look where the dark red was. Energy, utilities, defensive sectors. That's not going to move the market down, and it's typical when the market is, a little bit squirrely, you're moving down a little bit, you're going to get these sectors down. Utilities are really more like bonds, really, and the energy is going to move kind of lockstep with crude, right? But again, look at the rest of it here. Notice the difference in the colors. Light red or pink and light green. So there was really no major move down on Friday, even with that two-day low, and a lot of sector rotation. You can clearly see that wherever money was coming out of, it was coming into another sector, right? Let's check out this other graphic here. That was Thursday and Friday. Then I put this together, which is the entire week from start to finish of Monday through Friday, percentage change open to close, weighted from technology all the way down to real estate. And look at how we fared. This is really incredible. All positive except right here, right? The only sector down a little bit at the end of the week was utilities. But again, here's the deal. Look at the change here. 8 basis points higher in technology from start to close from Monday to Friday. So we know that early in the week, tech went higher and then sold off pretty hard and came down a bit, ending the week pretty much flat. While technology was flat for the end of the week, look at the rest of the performance here, starting with healthcare, financial, et cetera, going down. Up 2%, up 1%, up 2.5%, 1.3%, up almost 2%, up 2%. You see what I mean? So it's really just rotation. And again, this ties in very closely with what I was talking about last week about how this market doesn't need to come down at all if this sort of dynamic continues, where all we're going to get is some of the froth being taken out of technology, which I will totally agree with you is overbought. NVIDIA, et cetera, AI mania, I get it, but what's happening in the market right now, it's just coming a little bit out of there and into the rest of the sectors, and that bodes pretty well for the market going forward. Over to the charts for a minute so we can see the graphical representation of everything I just showed you on the other screen over there. As always, we'll start with an S&P daily. We're going to look at some weeklies as well, but I just wanted to start on this S&P specifically just to point out what I think are the key levels for next week. Pretty simple. I mean, I talk a lot about the 8 EMA and the 21 EMA. I talk a lot about the concept of stacking. You want to see that 8 above the 21, etc. Trend lines below us. everything's really the same. I mean, it's really just hunky-dory. Like I was saying, you had some positivity in the market earlier in the week. Wednesday was day off. And then these are the 2 days in question that we talked about a moment ago, saying Thursday was down and Friday made just a slight minor low. But look where we came in here to the 8. Look at the space here. In the futures market, we did come a little bit closer. We almost touched. But I mean, we still haven't even come to the 8. So you got to just basically take from this that stronger sellers are not here. As I said earlier when we were looking at the graphics on the other screen, strong selling when the market is really coming off is not rotation. Strong selling is all sectors being down, right? I think you guys all know what that looks like. Breadth on the market internals is going to be 7, 8, 9, 10 to 1 negative. Advanced decline lines minus 2,000. All sectors will be dark red. We're just not seeing that yet. For now, it's just gentle pullback in the 8. And this is going to be your key area right around the 54.40 area for next week that I want you to watch closely to see if that 8 EMA holds. Now, with all this talk of, I don't want to say bullishness, but I hope you understand that my talk is non-bearishness, right? There is a difference, right? There's a difference between bullish, bearish, or neither. And this is really a non-bearish commentary because I feel that everybody in the world is bearish. This is one of the most hated rallies we've had for a while, and I'm just trying to objectively point out to people that they shouldn't be hating it as much. But that being said, this NDX weekly is something to pay attention to next week. We know the technology started off the week strong and closed relatively weak, as we just saw on the other screen, where the net change in the XLK was only a few basis points higher than when it opened on Monday. And what that did, obviously, is it left this large topping tail on the chart. So you've got a reversal bar on the weekly NDX. We're not seeing anything this extreme on the S&P if you look at the weeklies, but on the NDX it is. I always say I'm not that big of a believer in the whole bottoming tail hammer, topping tail hammer, certainly on the smaller time frames, but I do start to pay attention when it goes weekly or monthly. The longer time frames seem to respect these big shadows or wicks on the charts more than the smaller time frames. So I am going to keep this in mind as I come into next week, that there could be a little bit of pressure on the NDX. If it was to come down here below, again, we could see some action to the downside. We are still well above the channel. We talked about this sort of narrowing channel. We've broken out. Weekly chart is way above the 8 here. Obviously on the weekly, it's going to look a little bit different than on the daily because you had this big expansion of range the week before. But again, it's just one data point. Remember that. You have a lot of data points to put together as you're navigating this market. You've got 11 sectors that make up the S&P. You've got 100 different stocks right here in this index. You've got market internals. You've got market profile. You've got sentiment. You've got tempo, momentum, etc. It's a lot of data points. So again, this is one data point. Keep it in mind. NASDAQ 100 looks a little bit toppy. And we'll see what happens next week. I do a very short video every morning that's part of a report called Peter's Pre-Market Perspective. This is really a way for me to organize my thoughts before the day begins, and it deals with market profile. Now, obviously, that's a really big subject, and we could just talk for hours and hours on the nuances of profile, but just keep this in mind, that market profile is extremely valuable for day time frame futures traders, but it also has an immense amount of import and application to longer term traders, and that's how I do it. I'm not a full-time futures trader. I know how to do it. I do it sometimes. If I see an opportunity, I might go for it, once or twice a week, but it's not really my MO. I'm on weekly options and longer term charts, and I use the market profile together with the technical analysis to sort of guide me and give me a better idea of what's going on inside of the candlestick. So I just want to talk about one specific nuance today that happened in this past week that I want you to carry forward in your narrative, so to speak, into next week's trading. And that's the simple fact that the futures market on the ES, and that's what you're seeing here, you're seeing kind of an interesting, different graphical representation of the futures chart. If you're not familiar with this, basically every letter is called a TPO, and each column is a letter, and each column represents 30 minutes of time. And so what the profile does for us, and this is why it's called the profile, because a profile is like when you're looking at the side of something, it shows us how much time was spent at every price level. And that's something that a normal candlestick chart that's very two-dimensional can't do. Inside of the candle, you only know the open, high, low, close when you look at that graphic, but you don't know how much time was spent at each particular price level. And that's what the profile does for us. And the time spent at each price level, the longer it is, the more value that there is. And the market generally is all about value and not price, right? My mentor in the profile, James Dalton, taught me that price is an advertising mechanism. Time regulates all opportunities, right? Time is just really the framework of the opportunities, and volume judges the success or failure of any auction. And really the first of those three rules always stuck with me the most, because I think it's just so important to understand price is an advertising mechanism. It's nothing more than that, right? Price is always just shouting at you from the charts, from your trading platform, from windows in storefronts, at the supermarket, etc., at the car dealership, right? All of these are just methods of advertising that are saying, hey, you, come interact with me. But it doesn't mean that you're going to transact at that price. It's just a starting point. So remember that. This particular chart, as I was saying, is just the ES E-mini futures. And the one nuance that I wanted to point out, although there are hundreds literally, is just the fact that the distribution that you see here, and I'll just give it a little circle, this activity right here, okay, this is the overnight session of Wednesday evening, okay? This is that overnight session going Wednesday into Thursday morning. These uppercase letters is just, you're not seeing all of it obviously, but you're seeing just a portion of Thursday, which would be June 20th. What I want everybody to carry forward is just the simple fact that in the futures market, the high of this particular move was made in an overnight session. Although the S&P never went anywhere near here as high as here, the ES futures did go all the way to here. A general rule of market profile that was, again, taught to me by Jim Dalton many, many years ago, and this is proven true in my experience for years upon years, is that auctions generally do not end in the overnight session. So just remember that, right? Auctions will not end in an overnight session. They can, but in general, the market will go higher eventually if it leaves an overnight high on the chart. So remember that. That's super duper important. We have a high here in this RTH, but this overnight session actually was much, much higher. Okay, so remember that. It can happen. We can sell off from here, but in general, you always want to carry forward these overnight highs, right? In the fact that they're probably going to get tested later, because it's just not the way things work. Auctions tend to end for real in RTH sessions and then move down from there in a bigger manner. So just keep that in mind. As I was alluding to before, so much more I could teach you about these charts. I highly recommend check out my morning report and video. I summarize everything that's going on in the market profile chart every morning in a very short 3 to 4 minute video. It's part of a longer report, but the video is really right up front and center. It's the first thing you see. So if you just want to watch the video, that's just fine with me. And what I do in that video is I break down all these nuances and talk about lots of key levels in the ES that your competition really doesn't know, especially if you're a full-time futures trader. It's definitely something you may be interested in, but as I said, lots of application for longer term traders as well, because it really clues you into a lot of nuance that's going on in the charts. And what I feel that it does for me, which makes it extremely powerful, is that it keeps me in trades longer than I would be if I was just looking at price action. It allows me to not get sucked in to prices doing something, A, B, C, X, Y, Z, it doesn't matter, because what I'm looking at is key levels in the profile that are either being tested or not being tested. Really, from this market profile is where the entire concept of WWSHD came from. That's a term, that I coined some time ago, which stands for when what should happen doesn't, right? So it's the same thing when you're looking at your daily charts or weeklies or monthlies or whatever. You may be looking at trigger points above or below certain highs. You may say to yourself, okay, this is a support level here in the chart. If it moves below here, I'll get out. If it doesn't, I'll stay in. That's great, but I'm telling you that with market profile, you can take that a step further and be a little bit more nuanced and get a little more granular with it and be a lot more accurate in terms of how you see value developing and where the nuances inside of the candlestick are that I think are going to keep you in trades longer and also get you better location on new trades that you're about to put on. Play of the week this week comes to us from Weekly Option Advisory, and it is Meta, aka Facebook. And the reason I chose this trade is for a number of reasons. The first being, if you recall, it was the #1 draft pick last week. I said that Meta had a chance to move higher up to the 530 level. The other reason why I'm choosing it is because it really showcases exactly what I do in Weekly Options Advisory, in that it had short puts in it, it had long calls in it, it had a long call structure that was actually net short, and I'll explain what that is in a minute. And lastly, which is really important, and I'll show you here on the slide right here, is that Meta did not do what we expected, right? If you recall, I'll go to the chart in a second to show you, Meta didn't really move up at all. It actually finished the week kind of bearish. It was one of the weaker stocks in the Mag 7, Fangman plus T, what have you, and yet the trade made money. We made plenty of money on this trade. It was a solid winner for us. Let's go take a look at the chart, and I'm going to show you exactly how this went down, all right? This is the Meta Daily right here, and as I was saying, the action of this week was not very bullish, right? Just to do a recap of what we were looking at last week, we were talking about this consolidation area here that led to a breakout, and it was pushing towards this downtrend line, and I was looking for a retest here of the 530 level this particular week. I thought that we would at least push to there. So what was my trade, and how was I able to make solid money on the trade even though the stock did nothing? I was able to do that through two specific applications, if you will, of how I approach the trade as opposed to how most people approach the trade, right? Firstly is that if I am going directional on the call side, I always want to be a put seller on the downside to finance those calls, especially if they are expensive. And in this case, I really was bullish on Meta. I was bullish on the market, and I thought that Meta would advance more than it did. As you can see, it didn't advance at all. And I thought that we had a chance of moving all the way up to this 530 level. So just to give you an idea of where I was starting my structure, I was long the 505 calls that expired today on the 21st. But I was long the 505 calls, but I was also short 3 of the 530 calls. And at the time when I put on the 530 calls, those were about 66 cents. So you can see that selling 3 of those gave me a discount of $2 almost on whatever I was paying for the 505. So that was my structure on the upside, was a couple of 1x3s, long the 505s, and going up to the 530 where I was short those 3. But given that those 505s were quite expensive, because I wanted to start as close to where price was right when I started, right? Price was right around 500 when I started the trade. I knew that I had to be a put seller as well so that I could bring down the rest of the cost of those calls, and I did that in 2 separate trades, both for the July 14th expiry and the July 21st expiry. So in the July 14th expiry, I actually sold the 490 calls. Those were actually DTE 0. I did them on Friday morning, collected a nice credit, and then went right into the 480s, and I chose those specifically. Why? Because look where the trend line comes in right here. Trend line is coming in right to about 490, so I felt that it was safe to be short 480 puts, as many as I could, against that long call structure. And the rest is really history, because what happened? The stock actually went nowhere. As we rallied a little bit, I was able to get out of the long call structures for about $2 to $3 of credit, but my cost was really $4 on that call side. But that $4 was more than made up from, well, of all the puts that were sold down here at the 490 or 480. Okay, so this is a fantastic example of basically what I do day in and day out in my advisory, in my trade room. These are the types of trades that I put on. And what it really does for us as traders is it simply sort of takes away from those trades that would be losers when you are wrong on direction. In this case, what I thought was going to play out technically obviously didn't play out. The stock didn't rally and it closed very, very weakly. So had I not put on this structure, had I been not thinking out of the box, had I been more traditional and just, I don't know, bought a 505 call, bought a 505, 515 call spread, where would I be, right? All of that would have attrition to 0, and I would have lost a minimum of 25%, 50%, or even 100% of what I put into the trade. But because I was able to structure like this, discounting that 505 with some 530s short, and then selling all those puts underneath, we actually turned a pretty garbage, crappy, price action into a profitable trade, all right? Check the link down in the description below, shadowtrader.net/options. I'd love to have you come trade with me on a daily basis. I'm live every day in the room, and there's links down in the description where you can take a 1-week trial for $7, so check it out there. All right, let's keep this weekly options talk going. We're going to do a little thing we call Should I Do This Trade right now. This particular week's entrant comes to us from a gentleman named Keith, who is actually in my room. He's in Weekly Options Advisory, and he wants to put on something bearish on COST, C-O-S-T, which of course is Costco. Keith says cost is nearing its long-term channel top. We'll get to that in a second on the chart, with sales softening. So right off the bat, that's a fundamental thing. I don't really deal in fundamentals, but I get it. Maybe in the longer term, the stock will roll over, we'll see. But he's saying some structure with a bit more time to it, looking for a retrace into the channel, perhaps a put calendar, talking about being long the 760 put all the way out to September, and then selling some 760 puts against it, perhaps July 5th for a total of about a $3.30 debit. The exact ramifications of the trade of what wants to be done here specifically are not that important. What I more want to concentrate on is that he's looking to put on a time spread, which is a calendar, meaning that he would be long a put further out, all the way out to September, as he was saying, for a big debit, and then selling puts at the same level but closer in time, sort of whittling away that cost. Let's look at the chart, and this is why I'm going to tell you that I do not think this is a good idea, and I don't think Keith should do this trade at all. This is the weekly chart in question of COST. The first thing you have to notice, it is ridiculously bullish. I mean, cost has just been on fire for a while, and this is really the first week where we've seen even the slightest sign of a reversal, where we have that topping tail forming on the chart, very similar to what I showed you in the NDX. So, could this be a turning point for cost and a near-term high? Certainly it could be, but in my experience, you do not want to fight this trend, and I think you do not want to put yourself into a situation where you have a debit situation on those puts. I get it that you're going to be able to sell against them week after week. He's looking at a 760, however, which is really way down here, right? The put in question that he was talking about is about a 760. That's generally not a good way to go about things using options weekly or even longer term, meaning do not choose strikes that are relatively far away and then hope that the market goes there so that that strike increases in value. That's the first reason why I would not do this. You really want to be doing a structure where the long put is much closer to the money, and then structuring that in some way, perhaps the inverse of what I was showing you with the meta, meaning why not look at this channel here, sell some call credit above the channel, 910, 920, and use that to finance a more traditional structure such as a put vertical or maybe even a wide butterfly. That's another way that I would look at this. I would say, okay, if I thought this was coming down from say 850 to 750, I might look out to that December expiry and say, okay, I'll take an 850 long put, I'll do 2 short puts at 750, and 1 long at 650, create a butterfly like that. Obviously, that's going to incur a good amount of debit, but if I was going to whittle away at it, I'd be selling calls every week against it, as long as the stock was able to, maintain a downward trajectory, right? So a lot to unpack here. I would say, first of all, don't look for bearish plays in stocks that are just now starting to turn around. Let them create bearish patterns first. That's basically my MO. I don't try to pick tops. I don't try to pick bottoms. I'm more active in the middle. You'll find over time that most professional traders act this way. They really get more confidence once trends begin, and they know that then they can put on their full size, because that trend is underway, and it generally is going to keep going because prices that are in motion basically tend to stay in motion. But trying to pick the tops and bottoms is often a fool's errand, and it's just a much harder trade to do. All right, so for all those reasons, everything I'm discussing here, I would say, Keith, you should not do this trade. However, since yours is the email that I chose, you are a winner of the free month of the Weekly Options Advisory. So shoot me an email, and I will definitely credit you for 1 full month. And thank you so much for supporting our room. All right, let's keep things rolling. Time now for our #1 draft pick. This is where I leave you with a chart for next week that I like, potentially a trade idea, something that you can do that's actionable for the coming week. This week's chart is Lam Research. If you're not familiar with this company, they're in the semiconductor space, and that's really the first data point, is that I like this space a lot. Obviously, this space has been very hot on the heels of everything that's happening in artificial intelligence. Lam Research particularly does not make semiconductor chips themselves. Rather, they make the equipment that semiconductor makers use. So their biggest customers are companies like Hynix, Samsung, Intel, etc. Companies that actually make chips are their customers. And as you know, that's kind of a good place to be, right? If there's a gold rush, you kind of don't want to be panning for gold. You want to be selling shovels and blue jeans and pans and things like that, right? But as always, let's move over to the chart because that's where the real action occurs, and that's really the driver of the trade, right? Is what specifically is happening on the chart, especially as it pertains to key levels in the chart, just like I talked about in the meta trade, right? We were not selling 480 puts just because it happened to be a number like, oh, let's just sell 480, or perhaps because, oh, well, there's 40 cents of premium down there, that's healthy, we'll take that. No, it's all technical, right? I showed you clearly that there's a uptrend line coming up like this, and the 480 is right underneath that uptrend line, so that's super duper important. So the same type of technical analysis we're going to apply to the Lam research chart right now, where I think there's a confluence of things happening that are going to be supporting the stock either here or a little bit lower, and I'll show you how I'm playing it. So Lam Research had a big breakout recently at this 1,000 level. You can see it kind of came close here, pulled back, and when it retested, you had this break here of this 1,000 level. And since then, you've pulled in a little bit with the market, kind of in line with what's happening Thursday and Friday. You pulled in a bit. And where did you pull into? You just pulled in right to the 8 EMA. That's always your first line in the sand. You start with the 8, you have the 21, you've got your trend lines, etc. So for now, we're holding above the 8. So right now, I'm already short puts in the stock in a little starter position. I'm kind of starting slowly, but I'm shorting puts already, and I'm short puts where? In the weekly options advisory, we sold puts today at 940. And why did we choose 940? Simple. It's underneath trend, and the premium was actually healthy because this is relatively high IV. It's got a week to go, and we got 68 cents for those puts when we sold them earlier today in the morning. So that's the starting point, right? The other trade that I think may make some sense here, but I want to see how things develop over the course of the week, is that I think it may make sense to be in some sort of a tight broken wing butterfly that's right here at about 1,005 with two shorts at the 1,000, and then instead of buying the 990, you would actually buy, instead of buying the 995, you would buy the 990. So you'd have this broken wing butterfly structure and collect credit that way rather than with a simple vertical. You could sell the 1,000, 990, etc., take on that 10 points of risk, but isn't it better to have a long put in front of your shorts, right? I've been saying this forever, and I'm always going to say it. The broken wing butterfly should be in everybody's arsenal. I can teach you this strategy. I use it all the time. If you are a strictly credit collection type of options trader, you should be using this strategy week in and week out. You should be using it as opposed to selling verticals because it is so much safer and there's so much more you can do with it. Now, that being said, do I sell naked? Certainly I do. I mean, I've got puts way down here at 940, but it's a combination of these types of strategies. And given a choice, I will always prefer the broken wing butterfly over anything else. So if the premium is there, that's kind of the way that you want to look at it, right? So I think there's a credit collection play here to be had in that way. Right now, I'm short those 940 puts. I'd like to put on more of those depending how it acts. But then also on the upside, I think there's a pretty good chance that we get a strong bounce here because what we're seeing is just the first pullback after the move higher, and there's so much of a confluence of support below us, right? There's lots of things happening. We already know that the prior high is here at 1,000, but beyond that, look at how everything's tying in. The 21 EMA is coming right to the 1,000 as well. So now you've got two things, right? Thirdly, look at the blue arrows here, which I specifically started from this day. That's called the anchored VWAP. Some people call it the AVWAP. AVWAP, I can't seem to spell today. That's the anchored VWAP today, starting from here. What is the anchored VWAP? Very simply means that you pick a location on the chart, you anchor the VWAP there as a starting point, and then that is calculating the volume weighted average price of every single transaction that occurred from here all the way to here. Actually, all the way to here, to where we are Friday, all the way to the ending point. And where is the volume weighted average price now? It's at 1021. The anchored VWAP on a move up is generally going to be very supportive. It makes perfect sense because this is the volume weighted average price where everybody traded on the way up. That's the general MO of how markets work. Remember, they expand from areas of, they expand from balance into areas of excess, and from areas of excess back into balance. And when they come back into those balance areas are almost always supportive, or at the very least, price has a difficult time cutting through those balance areas. They can actually stay there for a few days and just hold the trade, which is extremely advantageous if you are a put seller, right? Knowing where these balance areas are, knowing where support and resistance is, knowing where that anchored VWAP is can help you a lot. So I'm seeing that as a very bullish sign that that anchored VWAP right now is actually already above support, and that may be a support point that I'm going to be looking at next week to potentially take some of the money from the 940 puts, take some of that premium either from there and spend it on some sort of a call structure, which I haven't done yet. So if we were to come in, let's say to that area or to that 1,000 support, that's when I'd be looking, say, okay, how's the stock trading? How's the market trading? Are we still in a market that's generally bullish? As long as that NDX is not falling apart, as long as we're not in an all-out crash situation, I might be looking for a call spread here as well going into next week. And that's our show for today. Thank you so much for hanging out a little bit on this weekend with me. Remember, if you can, hit the like and subscribe buttons down below, and also that little bell that's going to notify you when Shadow Trader posts new videos like this, especially also the daily content that we put out every single day called Shadow Shorts. If you're not aware, you can sign up for those on our homepage, or if you're subscribed to the YouTube channel, you'll get a notification. Those are the short 3-minute videos that myself and my staff put out nightly, always salient, always some trade education, usually some trade ideas, key levels, things that you need to know. A lot of great content there. So again, sign up for that. Make sure you're getting those every day. All right. Let's recap what we talked about a little bit in the markets. The selling thus far has been mild, as I showed you on the first couple of graphics where we talked about the rotation. That seems to be the MO of the market right now. Some money started coming out of technology on Thursday, Friday, but as I showed to you, it just went into other sectors. Remember, the market is not going to come down harder or in a big way unless you start to see those get, all of those sectors rather garner some selling, as opposed to this rotational kind of situation that we're seeing right now. So we want to be watching those sector charts very, very closely from here on in. All right. Beyond that, key areas in the S&P and in the NASDAQ 100, I would say the two main takeaways for next week are, one, the 8-period moving average on the daily, that's both on the S&P and the NASDAQ, that's fine. And two, that weekly inverted hammer that I showed you on the NDX, right? That's a little bit more of a potentially bearish sign. We'll see if that turns into anything or not. It doesn't necessarily have to. We can have an inside bar where we're just there. I don't know. But anyway, I think I would be remiss if I didn't point out that reversal to you on that weekly chart in the NDX, all right? Next week, we're going to talk some monthly charts because it is going to be the end of a month. That's always exciting. We'll see how those charts fare, all right? I look forward to that. Until then, coming at you from beautiful Los Angeles, California, I wish you good trading and good night.